Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to talk about gold, copper, the declining ore grades, and the increasing energy requirements to get this stuff and pull it out of the ground. Um, when I look at this, and I know a lot of people are wanting to invest in the mining companies. They say, "What about this miner? Is this good to invest in?" And this is kind of what comes to the forefront of my mind. I'm going to show you some information, give you my financial opinion on this. And this is kind of what I think when I think of mining companies during an energy crisis. So let's go through some of this information. I'll show you what I'm thinking about and describe kind of my opinions around it. So if we look at the first chart I've got up, this is from Gold Supply Forecast Industry Decline. This is from Barrick Gold. It says industry is facing production precipice. Very few companies able to deliver value growth in this environment. And what you're betting on in a mining company is the margins of the company. You want to see growth, output growth, and you want to see their margins expand. So you want to see that the price of gold is going up faster than their input costs. And when I look at this chart, I don't see, there could be companies within, from 2022 onward, there could be companies within, the mining space that is growing, and those are the companies that you want to focus on. Probably small cap companies that are going into production in 2022 onward, and then can grow their production. But the overall environment is declining, which means that you're going to see, I think, higher gold prices. And it's not just because of the decline in the production and supply of gold. It's also where it's tied to the market conditions of an energy crisis. So when I look at the output decline and I think of the energy input, the energy costs and the energy crisis, this to me screams physical metals. It's why would you want to subject yourself to all the risk of the energy input costs going up dramatically? And I think they're going to go up dramatically here in the short term for oil and all these other energies, natural gas, oil, coal, whatever it is, electricity prices. So number one, this is the gold supply forecast. It's declining from 2022 onward. It's been declining since 2021. Now, when I look at copper, so looking at copper, this is the copper production historical and projected, and they have a peak. And if I were to just look at the peak here, the peak is like 2030 something, 2030, 2032, whatever it is. But we've got this nice gigantic demand, the dotted line here, outpacing the supply. This is a great long-term, very long-term investment, is copper. But the one thing that gets me going, and I know as we get on this decline side back here past 2030, that the energy inputs are going to go up dramatically. So when I think copper, I think energy. When I think gold, I think energy. And the limiting factor of copper and gold, in my opinion, is going to be energy. And that gets me to think, well, even though copper could go up in its price, and even though everybody wants perhaps copper, the limiting factor of its production, I think, will be energy, and we'll dive into that here shortly. So that this is copper, the way it looks, the curve of 2030. I think gold, we already hit it, and we're starting to decline. People say, well, we're going to have to find new copper deposits, new copper mines. We're going to have to find new gold mines. We're going to have to find all these different mines. But here's the problem with those mines. And I'm going to show you a couple of charts here before I get into the data there. So here is the direct energy consumption of the largest traded gold mining companies. And if you look, energy, which is the direct energy cost, operating cost, this is the percent. Some of them, 50%, 27%. self-reported energy exposure here, energy intensity of gigajoules per ounce ton. And this is just the consumption of energy. This is electricity, not from fuel. This is their fuel costs. And this was done back in 2016. So I know it's difficult to kind of see some of this, but Barrick Gold and all these, and these are going up over time, not down. So another one I want to put up here is energy accounts for 50% of gold production costs. That is the all-in, energy costs. Think electricity, fuel, all of those things. So this is energy cost as percent of cost is 47% of its all-in costs. So when I think of an energy crisis, well, you're betting on a mining company that the gold price is going to go up faster than the energy price. If we're in a highly inflationary environment where oil is going up, dramatically, and we have an energy crisis, and the energy costs as a percent of the costs of gold production and just mining in general, it's going to really squeeze the margins. So they could be making money, but they're just making less money. And it's important what multiple things do here. So betting on a mining company isn't a direct bet on that gold's going to go up. It's a bet that gold's going to go up at a faster pace than oil. And when we see these outperformances of the mining companies, they tend to happen at the beginning of the cycle when gold kind of takes off first. Then the mining companies go ballistic because oil prices haven't responded yet. So gold usually responds quickest, and then oil lags behind. You get 6 months or so, and then oil starts to take off. On the back half, usually the physical metals do very well on the back halves, and that's kind of what I'm thinking may outperform in the back half. It's not necessarily the mining companies, but a lot of the physical metals. Physical metals also protect you from currency problems and all those types of crises. Here's another one. This is the endowment and gold exploration spending. The green line's the spending, but look at what they're finding. Less and less and less. And I know this ends in 2011. I don't know what it is past that, but they are finding less gold endowments. So they're finding less gold over time, even though spending has ramped up. If we look at the annual gold price and the weighted average head grade, this is your ore grades. Your ore grades are declining over time. That's the red line here. And your gold price could be going up, and it's not going to impact your grades. And the grades continue to fall and fall and fall. And when you look at some of these guys that they're looking for grams per ton of material, they're getting down to like 0.5, 0.6, 0.7, 1.0. And those are like good finds now. Very low grade, very energy intense to get out of the ground. So when I look at a couple more here, this is our ore grades all the way from 1830 to 2010, and they do continue to decline. USA, South Africa, Canada, Brazil, Australia. And you can see a left to right, upper left to lower right with ore grades. Declining ore grades means increasing energy input. So when I was looking at this, I wanted to get some copper information because they usually have good information on copper. So what this is your copper production in the bars. You can see the bars going up. We went from 4,700 to 5,700. 4,700 to 5,700. Your total energy is in the blue. Look at this thing. We're at 100,000, 90,000 terajoules, all the way up to 160,000 terajoules. Now, production of copper production only went from 4,700 to maybe 5,700. That's in 1,000 tons there. Now, your total energy to do that went up dramatically. It went from, up almost 60, 70% up. And your production here only went up, say, 25%, 25%. So it's a we're dumping in way more energy and getting less back is what I'm trying to say. And when you start to invest in these very low ore grades and you're in the middle of an energy crisis, I think energy is the bet to bet on. It's not necessarily these companies that are going to be large energy consumers, which is a lot of the mining companies. It doesn't mean that you don't want to invest in some of the mining companies, but it's something to keep in mind when you're looking at this. So this is what they've got looking forward. And to give you guys some more information on this, what's happening is you've got your ore grades that are declining. That's the x-axis here that moves to the left as it goes down. Your cumulative energy demand goes up. And when you hit certain ore grades, this is for copper, when you hit certain ore grades, it really starts to dramatically increase its energy input. Now, there's a couple of things that people are banking on. They're banking on technological improvements, the efficiency to get things out of the ground. And what you see here from 1930 to 1970 is we are getting more efficient at yanking it out of the ground, even though we have lower ore grades. So we can see that the cumulative energy in total has declined from 1930 to 1970 because of the technological improvements. But as we go up in time and the ore grades decline further, we're actually using more energy per ton of copper from 1970 to 2010. Now, if we continue to decline in the ore grades, we could see this start to hockey stick higher in terms of our energy consumption in relationship to tons of copper produced. So when I went and I tried to look to see what is kind of baked into the cake here, this is what people were saying because of technological improvements. And this is their opinions on it. So they're saying 1930s up here, we had an improvement from technological improvements from going down here. So we had declining ore grades, but the technology improvements overcome the energy inputs. So we became more efficient at yanking it out of the ground. From 1970 to 2010, we had an increase in energy per ton of copper. But what they are projecting is technological improvements and technological improvements plus renewable energy. They said the future is going to be down here, where we can increase the efficiency of gathering copper out of the ground and using less energy per ton. And our ore grades, I think, will be somewhere in 0.5, 0.4, and 0.3. So if we even come up here, I still think we could use more energy depending on the ore grades and what we're going to ramp up in the future. So remember, this is a gigantic decrease. And with the increase in output of copper, we are going to have to bring on more marginal mines that are in this 0.4, 0.3 range, I think, and 0.5, as these are the new mines that will come on. So I think this will naturally migrate up this curve. I think a lot of people are looking at renewable energy, but I think where it's going to be more like the green, where we're going to go up. The purple. I think we're going to go up in energy consumption, and I don't think that this is going to go down in terms of renewable energy. And I don't know why it would go down using renewable energy. You're still using electricity and a bunch of other inputs. And in order to have renewable energy, that also has a bunch of inputs. And if your energy return on energy invested is lower for renewable energy, I don't know if I necessarily agree 100% with the chart that they have here. So I think that there's a high probability that we could get up in this range up here, where we start to really ramp up our energy consumption versus tons of copper. And that is what we've seen in history from 1970 to 2010. That is exactly what we saw in the chart that I presented right here, which is, and I don't have the bottom here, it got cut off. That's what we're seeing in total energy. It's going up in relationship to copper. So I would be careful to say that that we're going to become more efficient pulling this stuff out of the ground right off the bat. So that is something I wanted to cover and let you guys know kind of what I'm looking at. This is the charts that I'm looking at here. To me, thinking about energy, it makes me more bullish on energy than any of these charts and materials. So if someone says, well, you're bullish on copper, I would say yes, but I'd rather invest in energy because I think the limiting factor of copper is energy. And I don't know if the margins of the copper miners are going to remain the same, go up or go down in an energy crisis environment. Then it becomes how important is copper to society, and what are people willing to pay for it, and the delta between the energy input costs and the price of copper or whatever other material. I'd rather just own the physical, and I'm not saying to go buy physical copper, but physical gold, physical silver, physical platinum. The energy to take these out of the ground. We were in a plentiful, cheap energy environment. And I think that environment is changing. We're going to see a structural change in the cost to produce all of these different materials. So the easiest, cleanest, least risk way to play it is just buy the materials. I mean, it's that easy, the way I look at it. And if energy is the limiting factor for a lot of these things, energy could be the limiting factor for materials. Energy could be the limiting factor for any of these commodities. It is a limiting factor for the inputs for some of these manufacturing facilities over in Europe. And if energy continues to be short, then energy is, in my opinion, the spot to be invested. If you guys need help navigating these markets, you can sign up to the Platinum membership. That's right here at Finding Value over here. You can sign up. I can show you the companies that I'm invested in for oil, natural gas, uranium, and all these other energy-related companies. I also talk a lot about physical metals, ratios, and all that stuff. So there's that as well, and a bunch of other financial education stuff that I put on the website. It also includes even these charts that I presented here. So that's what I've got for today. Give me a thumbs up if you guys like the content. Subscribe to the channel if you haven't already, and we'll catch you next time. This is Finding Value.